Hello everyone, I hope you can hear me all right. We'll be starting in a couple of minutes. I'll just let more people log in and then I'll start going through all the slides. Hopefully you can all hear me and you can see me all right. And hopefully you can see my screen and the slides, most importantly. Okay, so it's 5 o'clock. I'm going to give people a few more minutes just to log in. I think we're expecting 50, 60, maybe even 70 people have registered. So can't imagine so many people want to see me on a Friday, but there you go. Like I said, I'll give them a couple of minutes. Obviously, today's webinar is about investing in uncertain times. Certainly very uncertain times at the moment. And it's basically, how does COVID-19, the global lockdowns, weak and unknown corporate earnings and economic data affect our investments? So that's the main topic for today. I don't know why I put this slide in. You can all see me anyway, but hello, that's me, Ian Pryor. I note from the list of registrations that many are clients. I recognize a lot of names. Some are new to me, some are other people's clients, and some we've never met. So that's just my contact details in case after this you have any questions and you want to ask me about anything. We will send out a copy of this to everyone, and of course I can share the slides with anyone that wants to flick through it themselves without me speaking and without these few minutes at the beginning. Basically, the agenda for today will be pretty short. We do have an hour, so I'll give a couple of minutes for people still to join, but I do want to try and get through this timely. I know we all have things to do. Many people have children to attend to. Some people want to have dinner or wine o'clock, as it. I think, is that a guy over wine? Yes. Wine o'clock at 6 o'clock. We've all got things to do. And I guess some people, not everyone's in Singapore or Asia. I noticed that there's a couple of people who are based in Europe, someone actually from America as well. So is it good morning or good evening? I'm not sure, but anyway, so the agenda will keep pretty tight. I'll try to actually finish each section before the stipulated time. I think the key points will obviously be towards the end, what to invest in, when, how, what areas should you invest today, should you wait? All of the key questions that, really I've been asked many, many times, pretty much every day, well, I guess for the last few months. So the idea is to address, a quick introduction in terms of, the scenario with COVID-19, obviously a disclaimer, very important, what the effects on the markets and global economy has been, what we're doing, how we work, and, hopefully how we add value to clients. And like I said, most importantly, the key section, which I'll try to come to sooner, is when, where, and how to invest money today. We will have a Q&A session as well. Q&A, it says 10 minutes there. If we finish early, great. I'm happy to extend on for those that can go past 6 o'clock. Basically, if you do have a question, there's a Q&A tab that you can click on, and hopefully I'll be able to see them. I can't actually see the tab right now, but there we go. Yeah, so Zoom actually has a Q&A section. So if you just click on that, type your questions. I'll try to leave it to the end, to be honest. But if I do see one pop up and I think it's very relevant to the slide, then I'll just throw it in very quickly. But I can go back through the slides anyway. So I think let's just give everyone maybe one more minute to log in and then we can start. Okay, I think let's start. Just giving everyone time to log in and get ready. So today we'll be talking about investing in uncertain times. We all know it's very uncertain at the moment. Those of us in Singapore have been locked inside for the majority of it. And I think actually most people around the world at one point or another have or still are experience a lockdown. So certainly uncertain times. For those of you that have just joined, that's the agenda today. I will try and get through it quickly. I will absolutely finish spot on 6 o'clock, ideally earlier, so that you can all get on with whatever else you have to do today. Thank you for joining us, and I will start now. I think that's enough time. I can see there's lots of people who are in ready, so I think we'll start now. So just very quickly, I mentioned that I recognize a lot of names. There's lots of clients on here that I know and many that I don't. So just very quickly, who are we? IPP in a nutshell, founded back in 1983, which actually made us the first comprehensive financial planning company in Singapore. So we're a licensed financial advisor with about $2 billion of assets under advice, 50,000 clients. Zoom actually didn't have that sort of capacity, so we've limited this to a maximum of 100. But anyway, so that's our services. How can we help? Obviously, we do the personal and the private wealth side of things, which of course is what most of you will be clients of mine on, but also the corporate advisory side of the business as well. So we're quite a broad financial advisory company, but of course the core to what we do typically is investments and financial planning, which of course involves investing. So, okay, just very quickly, disclaimer. I've been told by compliance this is actually the most important slide of the night. I disagree strongly, but there you go. Just take a second to read through that. It's pretty much the usual stuff. In fact, there's actually 2 slides, disclaimer. I don't think I've seen that before, but I've been told to put it in. Anyway, I guess one of the things on here is our website. If you're not familiar with us, please feel free to go to it and get a better feel for us as a company. And really, I guess the disclaimer, just to put it in short terms for everyone, is, you know, we're going to be talking about a lot of things today. Some of it is house view, some of it is my opinion. A lot of it is sourced from external sources. We deem all of them to be reliable. I will put the source in the slides, and whether not, I'll mention it. And yeah, it's basically just a disclaimer. If you make investments on the back of this, please don't blame us if it goes wrong, especially if you don't take advice. But of course, look, if things go well and you get some good stuff from this, which hopefully you do, please do feedback, please do thank us, and please do give us credit for it. So here we go. Uncertain times, generally and for investing. I think, like I said, we've all gone through a very tough time. This is really, I guess the only word is extraordinary scenario. I've never encountered anything like this, and hopefully never will again. So it's really been very uncertain, both for people personally, their families, maybe job security, worried about getting the virus, and, you know, loved ones and people, you know, unfortunately getting COVID-19. Of course, it's been very uncertain for investing too. It's been a very uncertain time, quite a roller coaster ride in just a few months. I put there pandemic because it did become a pandemic. Obviously, a pandemic is something that, an epidemic that crosses borders. Hashtag COVID-19, that's me trying to be very millennial. And I guess it's a throwback across to social media. Social media has created quite a storm, well, the media generally, and perhaps has added to the uncertainty. But I won't go into too much detail around that. This is not going to be a COVID-19 discussion. I think we'll have many of those pretty much every day anyway. So, but the one thing I did want to point out was another hashtag or saying that's come about in this is the one global pandemic. That seems to be on pretty much every headline that I see. And I guess it sums up the media. It's not really a valid term. Pandemic in itself is global. So having a term of global pandemics a little bit silly, but anyway, there you go. So the first section, the Great Lockdown. This was a term actually coined by the IMF, the International Monetary Foundation, and they put this in the World Economic Outlook document for April. And yes, I guess, like I said, no matter where in the world you're based, living or working, or wherever your family may be around the world, we've all experienced lockdown to one degree or another. And it's been a new experience. It's been a frustrating one. Yeah, it's certainly a great lockdown. Anyway, hopefully it will be past us. In Singapore, we have the circuit breaker, as we called it, and just talk a little bit about how the lockdown actually has affected us. So we've had, I guess, a few different things that have come out from the lockdown. One is on a personal level, one is more on a sort of global and economic level. WFH, work from home, that's become a very well-known acronym. And again, many of us, including myself, have been doing this for, well, a very long time now, actually. Again, social distancing, personal hygiene. Hopefully personal hygiene is not new to us. Maybe it is to some, but yeah, these are all new norms. I mean, in the world of economies and logistics, we've had the supply chain disruption, again, from people not working, from trade not happening. Then we had a demand freeze. We still have a demand freeze where people simply aren't buying anything or doing anything, mainly because we can't. And bankruptcies. I'll come more onto bankruptcies later because it's quite a relevant thing and something perhaps is only just beginning. So as I said, in Singapore, we've had the circuit breaker. I'm amazed that it wasn't a three-letter acronym, knowing Singapore, or many just use CB. Started 7th of April, it ends in inverted commas, next week. I'm not sure that picture is actually that relevant. It's a very, very gradual reopening in Singapore. Slightly frustrating, I believe, from my own personal view and also from many that I've spoken to, but I guess it's better to be safe than sorry. And of course, in Singapore, we're doing it in 3 phases. So phase 1 starts next month. Phase 2 will be the opening of far more businesses, and we'll be able to go out again and do all the things we like and see people, which would be good. And then eventually phase 3, which would be travel and I guess normality, if we're going to get back to normality. Let's see. So just quickly on COVID, this figure here is a big number. It's from the ECDC, which is the European Centre for Disease Prevention and Control. It's a little out of date. Obviously, this changes all the time. But this is just from a few days ago. It's approaching 5.5 million. So it's a lot of confirmed cases. If I scroll down to the next one, that's actually, unfortunately, sadly, the number of confirmed deaths around the world. Again, as of 25th of May, so slightly out of date, but approaching 350,000. It's very sad, and I hope no one here has anyone close to them that has been affected in this way. It's often been compared in the media and sort of analysis to the Spanish flu. This is back in 1918, 1919. The CDC in America actually puts, you get varied numbers, but the CDC in America says Spanish flu created 50 million deaths in those 2 years. So, just to put some numbers in perspective, that's quite a big difference. Of course, this isn't over yet, so hopefully we don't approach anywhere near that. And anyway, it's not a good comparison. It's a different virus altogether. And of course, healthcare is so much more advanced now than it was back in 1918. Another interesting stat that I want to put, again, just to put some context to these numbers, because it is a big number and it is horrible. But actually, according to the World Health Organization, back in 2016, there was actually 56.9 million deaths worldwide. So as a percentage, look, this is still very small. Like I said, it's still a very sad and horrible number that hasn't finished yet. But also in that year, in 2016, people always say, well, the flu kills people anyway. What about heart disease, which is the biggest killer in the world, worldwide at the moment? An interesting one, which again is very sad, but in 2016, there were 1.4 million deaths resulted from road accidents. So again, that's significantly higher than what we've seen from COVID so far, and hopefully we don't get anywhere near those numbers. Anyway, just to put it into context. So that's me. I've got a new sort of profession, a new skill and expertise. I'm a scientific medical expert. I'm not. This is a joke, of course. I'm far from it, and that's why I'm not going to be talking about COVID. I think one of the things that have arisen from this whole COVID-19 scenario has been hundreds of thousands, maybe millions, of new scientific medical experts that suddenly know everything and anything about diseases and viruses. It's a bit crazy. What's interesting on there is obviously the guy has all of the gear, he's well equipped, he's got a very, very good face mask, what looks like an anorak actually. But then he's holding his mug and his newspaper without gloves. So that probably sums up the new load of scientific medical experts that we have. Anyway, on to more important things. So economies and stock markets. This is what we're here to talk about. This is why you all signed in. How has this COVID-19 scenario affected our investments and affected our, our life in terms of, the economy and our jobs and the business sector? So the first step was obviously stocks crashed. We had a supply chain freeze, manufacturing stopped completely, actually, pretty much at one point at the end of February, early March. That then very quickly changed into a demand freeze. So it went from a supply problem into a demand problem. Demand problem, again, we're all in lockdown. People are losing jobs. People are worried about the future. People aren't spending. And again, of course, it's a factor of the supply problem. Perhaps even if we want to spend, we can't. We couldn't buy the things we wanted. I know a lot of people that wanted the new Apple iPhone, which came out around then, couldn't get it, still haven't got it. So that was one of the problems, which was compounded. You had a supply and a demand problem. Of course, stocks crashed. You can see here, I've done the chart. The blue line is the MSCI All Country World Index, so basically global stocks, and the green is the S&P 500. And the reason I put both up is so that you can see that it wasn't just a particular market that crashed, it was pretty much across the board. So from the 19th of February, which was, the end of the last peak, we actually saw right down to the 23rd of March, a minus 33.64% decrease, which is pretty significant. Again, some markets were steeper, some less so. Again, it depends what currencies you look at, but just using this as an indication, that was a huge hit. And what's worrying is not necessarily the minus 33%. It's the fact that it's done in a month. That's what's worrying. It was a very, very violent and fast correction. But there are responses, masses of responses actually from governments around the world. And governments have pretty much been in a damned you do, damned you don't scenario this whole time. And I imagine that will continue actually. Again, I'm not here to talk politics, but you can look at the whole world was very, very proactive in a big way, in a really big way. I mean, in America, the Fed cut rates across 2 emergency meetings in just 2 weeks, which is unprecedented, right down to the 0 to 0.25% level. So interest rates are very, very low there. Actually, in Europe, we've already got interest rates at a negative across the Eurozone. In America, we also see unlimited and open-ended quantitative easing, trillions of dollars of market liquidity, and a 2.3 trillion boost to local governments. That includes loans to small businesses, state bond buying, and even money to certain families. It's quite hard to put all these numbers in a relevant context. Trillions is just a ridiculously large number. Certainly when you look back to 2008, you look at what America's doing, well, and Europe and the rest of the world, it's really unbelievable. 2008 pales in comparison, 2008 to 2009. The EU's total fiscal response to this pandemic has been 3.2 trillion euros. Really quite crazy. In the UK, we've seen interest rates cut to an all-time low of 0.1%. The very well notorious, I should say, UK government furlough scheme. And in Japan, so it goes all the way across Asia. Japan, we've seen economic stimulus package equivalent to 20% of the economic output. these are just phenomenal, mind-blowing numbers that all happened very quickly. Singapore just recently, in the last few days, introduced a fourth stimulus package. Again, that totals up to 93 billion. Very small compared to America and Europe, but it's a huge number. Again, it's 19% of Singapore's GDP. It's just massive. Interestingly, China, which was the cause, if you believe some stories or not, but certainly was the first place to be really impacted by all of this, has actually done relatively little so far. And that's interesting, and we'll come on to that in a bit more detail later on. So, of course, what happened? We had all this massive stimulus and fast government action, and stocks have surged. Again, looking at the same chart using the S&P 500 and the MSCI World, going from that bottom point, which was the 23rd of March, right through to now, or actually not now, it was a few days ago now, we've seen a 34% increase. So again, very, very quick rise, and it's actually been surprising. I think the initial rise was not a surprise. I fully expected something, again, because everything fell too fast and too much. But whilst this might have been expected, I did not expect this continued upward trend. And you can actually see a slight divergence now. US stocks are rising slightly more and slightly faster than the All Country World Index, but largely following the same pattern. So it's really been quite a big rise. Just one thing to note, I know this says plus 34%, the previous slide said minus 33%. Obviously that's not a full recovery, as I think all of us know, but it actually would take roughly around 50%, 50, to get back to where we were. Interestingly, the last few days we've seen another few percent added. So let's see what happens, but it's certainly recovering, shall we say. That's it in its full picture, so you can get a proper context on it. So again, from the sort of start of this, from the last peak down to the recent bottom, and then again the rise in the last month and a half, 2 months or so. So it's been quite a journey. I was saying to a client just before this, I had a quick call to do a review, and it really seems like this has been 6 months, 9 months, maybe even 12 months, and yet it hasn't. All of this started at the end of February, and we're now just coming to the end of May. It's really extraordinary. Anyway, so that's what happened, or what is happening. What about us? So what do we do? How have we added, or hopefully added, value in this period? Obviously, we give regular client communications. We try to keep you, up to date with what's happening as much as we can, and of course, specifically to your investment portfolios. We actually run a automated management strategy as well. It's not available on all the platforms, but we hope it will be. And really, that is built from our core sort of methodology, if you like, in terms of how we analyze markets and look at investments, and really take all of this into consideration. So yeah, we're a Singaporean company, so a 3-letter acronym, FTQ. So we use fundamental analysis, technical analysis, and quantitative analysis. And it's all based on historic data. In fact, we look back in history as far as we can. IPP's house view is actually formulated by an investment division. And one of the key metrics they look at is actually not the MSCI World or S&P 500, but it's the Dow Jones Index. Because frankly, the history is longer. There's a lot more data that we can look at and analyze. From that, we obviously find the best solutions and try to create model portfolios. Or, as I mentioned, in the case of some platforms, we actually have an automated system, which is Eagle Eye, which I really hope we can get across onto all of the platforms. Anyway, I'll share a bit more on how that's done in a bit. Just to look at the Dow then with a bit of context, you can see here how quickly 2008, 2009 is forgotten. You look at this drop and then you look at this drop. And I think this has been the big thing for me. The global financial crisis, I can remember I just joined IPP that year, been in Singapore for 2 years. And that was a questioning of our entire financial system. we actually genuinely didn't know if the entire system would collapse. It was a systemic banking crisis that spread across the world. Yet you see this line here, which was, from memory, very, very violent and very steep. And you look at it versus the recent one, it's really quite a drop. So anyway, that's giving a bit of a longer term picture. Not to scare anyone, the last peak before the global financial crisis was here. If you look from the sort of next peak here, and then you see a dip, and then you see a recovery almost back to it. If I could zoom on that, which I can't, but if I could zoom on that, it actually quite worryingly looks a little bit like we are right now. Anyway, I'm not suggesting that's still to come, but it's interesting. It's interesting to look at all of these sorts of things. So anyway, that's the Dow. What do we actually do? So do we just sit there? Do we just wait? Do we just feel all of this? Do we do nothing? Now, of course, every client's in a different scenario, and we do different moves and portfolio changes according to your individual needs. But as a house, like I said, we do have a house view, and we do manage these automated portfolios through Eagle Eye. And actually what we did was we added equities. On the 16th of March, we added an extra 10% to equities across all of the risk profiles. So that's whether you're conservative or whether you're very aggressive. We added an extra 10% allocation because we thought it was cheap. Like I said at the start, I feel that whilst perhaps this recovery is unsustainable, it's certainly surprising. The initial recovery was not. We simply lost far too much, far too quickly. Is really far too much volatility. So again, we made this decision on the 16th of March, and it wasn't bad. I've got a chart here just to show those two indexes again. Didn't hit the bottom. We were exactly 1 week off, but it was when we hit minus 29.2% on the MSCI. Actually, it was minus 30% on the Dow Jones, which again, like I said, the house view is formulated via our investment division, looking at historical data, and we use the Dow Jones a lot for that. If I go to the next chart, you can see why. This minus 30%, which is in a recession, it's really a 1 in 10 year event. Like I said, we look back, this chart goes from 2006 to 2011 or 12. But we look at the Dow Jones because it goes back 100 years, over 100 years. And that's where we get real data. If we look at some of the newer indices, perhaps we don't go back in time as much. Of course, the world changes, but again, this minus 30% has happened on average once in every 10 years. So it's really quite an opportunity. Once in 50 years, minus 50% is a banking crisis. Obviously, you can see that there in 2008, 2009, which is what I mentioned earlier. Again, just to put that into context, in today's chart, this is the Dow from the end of last year right through to now, or middle of April, in fact. And you can see there, this is the minus 30% level, and that's why we made that call to add. You could say we're too early. I don't think it was about market timing necessarily. It was more about providing some guidance to say, minus 30 is too much, it's too soon, and it's a good opportunity. Again, just some quantitative numbers here. This is all, of course, hypothetical and what ifs, but yeah, investing in the S&P 500 from the 16th of March, which is when we made our changes, to today, or rather a few days ago, that would have given over 25% returns. Actually, if you'd waited a week later, or in fact, as it often takes about a week to do paperwork, administration, and actually do the trades, it would have been perfect. It's pretty much slap bang at the bottom. You can see 1 week in the bottom is exactly the same, plus 34%. Anyway, so that's all hypothetical. These are the real numbers. If we look at 2018, I take our very aggressive because it's closest to the market, outperformed the benchmark very slightly. Importantly, because risk management is so important to all of us, because most of my clients and the majority of you who are listening to me now are not speculative investors, or rather we're not handling the speculative side of your accounts. They're much more towards a longer term
So again,
what's fantastic is in April, the rebound was significant. We actually really outperformed versus the benchmark, which is very pleasing. So anyway, that's all historical, and that's only for Eagle Eye automated strategies. I can't cover every single fund that we use or every single call that we make, but I'm going to just highlight a couple which are personal favorites, and I use as core funds whenever I can, whenever they're available on the various investment platforms. The red line, or A, is Fundsmith. The green line, or B, is the United Global Quality and Growth, and C is the market. So I used All Country World Index for this one. So if we just simply look back again to the last peak, right through to now, or a few days ago, it's actually the 26th, really quite good. You know, the market's lost nearly 13%, whereas Fundsmith's lost only 1.2, and Global Quality Growth has lost about 8.87. So yeah, really very good. Anyway, as a lot of people say, you know, that's still a loss. I don't want to lose money. I understand that, and I agree with that. But of course, this has been quite an extraordinary time, as I've just covered. Interestingly, I find this fascinating. Actually, if you invested, I've now done this at the start of the year. If you invested at the start of the year, markets are still down, but actually both of these two strategies are positive. I've done this in Singapore dollars. I appreciate that not everyone is living in Singapore, but I think the majority of our clients are. So, you know, when you're getting 0.5, maybe 1% in the bank with fixed deposits, even with all of this crash and uncertainty to today, you know, we could have actually achieved 3.2 or 1.4% positive growth already. So again, these are just some of the core funds that we use and that I like. Again, this is all historic. This is what's happened. I think everyone wants to know what's happening next. So what should you do now? What's going to happen? Of course, I don't know. I don't have a crystal ball. I certainly am very pleased to see the market recovering. I'll never complain about markets going up. I must say my personal view, and this is not a house view, our house view has not changed. My personal view is that this recovery currently, I think, is quite hard to sustain. I don't think there's enough fundamental background there to really prop it up. But what should you do then? Should you invest now? Where should you invest? This is what I want to try and cover in these next few slides. So, to invest or not to invest? That is the question. This is not actually relevant to today in terms of the reasons not to invest. I think this is actually always the case. There are only two reasons, in my opinion, not to invest. I should actually say three. The first one is you don't have any money. That's the first one. Or you have debts that you need to pay off. But really, there's only two reasons. And the key one for me is that you don't need money. You don't need the money for a short-term reason. Maybe it's clearing your tax. Maybe it's relocating to another country. Maybe you're saving up for, you know, something fairly significant. That's going to be within the next year or two. This is short-term money. Again, you can speculate on shares all you want. That's not what we do. We look at investing, and we're talking about investing today. So that's one reason. And the second is obviously slightly different, but maybe relevant to some of you. If you're retired or retiring soon, you've already reached financial independence, perhaps, and this is a perhaps, that's a reason not to invest. We still need to consider inflation. Inflation will almost certainly be a factor that comes about from COVID and the lockdowns. Some countries and some areas are already seeing this happen, in fact. But I think almost certainly we're going to have an inflationary environment after this. What's definite is we have low and negative interest rates around the world. Nowhere is yielding high interest at the moment. And I really genuinely can't see that changing in the next 2 or 3 years for any country. and for the next 5, maybe even 10 years for some countries. I really can't see a high interest rate environment for at least another decade. Of course, the other one is if you have money that's not needed in the short term, because you can take on some of these fluctuations and some of this shorter term risk in order to grow your money in the long run, because money in the bank just doesn't yield. In fact, it loses value. Inflation kills the value of money. And of course, if you have medium to long-term financial goals to make, these are always the key reasons to invest. I say long-term, I'm not saying this is going to happen again. This is from the last crash that we had right through to the last peak. Again, the minus 30% is at a once in a 10-year opportunity. But you look at all these different colors. The top one, the yellow one's the S&P 500, which is what we were looking at earlier. So from March the 9th, 2009 through the 14th of February, 2020, you're looking at a plus 527% return. Now, again, I'm not saying that's going to happen again. I'm not saying that's going to start tomorrow. I'm not making any sort of specific call, but it's interesting that these sorts of numbers, which are large, are there. So again, when you're trying to assess whether you should invest today or not, hopefully I've persuaded you yes already, but does it matter if the market's moved up already? Does it matter if you think the market's going to pull back tomorrow or next week or next month? 10% up, 10% down is very small in the context of 527%. So it's certainly something to consider. Anyway, so what to buy? Do you just buy a S&P 500 ETF? Is that the way forwards? I guess really you have two key choices, whether you're looking at equities, whether you're looking at bonds, alternatives, whatever it may be. You really have two choices: ETFs, exchange traded funds, and managed funds. They both offer a lot of benefits, namely in diversification and the cost as well, because buying and selling shares can be expensive. You have trading costs, etc. ETFs in particular are very easy. You just follow a particular index or a sector, and you don't have to do anything. It automatically rebalances to follow it. ETFs are very, very low cost. They offer that diversification, like I said. One drawback perhaps is they have fixed holdings. So they do literally mirror a certain index. Interestingly, I just checked my notes here for this. Interestingly, in 2008, there was $500 billion in ETFs. Today, anyone want to guess? Oh, I can't hear you. Today, it's just over 4 trillion, sorry, according to CNBC at the end of last year. That's a huge increase. Perhaps it causes some of the volatility we see because, again, the holdings are fixed. So if everything's going down, everyone's selling, prices are going down, everyone moves in the same way. The same, of course, happens on the way up as well. So perhaps ETFs are contributing a little bit to some of the volatility we're seeing these days. Managed funds, the biggest downside is the cost. They're obviously much more expensive than ETFs. They still give a diversification, but the key is they have flexibility in what they hold. Cheap isn't always good. Yes, a lot of managed funds around the world, quite frankly, just don't justify their charges. But there are many that do. And I think the two core funds that I showed you earlier are two great examples. I don't think anyone minds paying a higher management fee if the return you're going to get is plus 2 or 3% versus minus 8 or 9%. Anyway, so these are the two key options, I believe. One thing also to consider when you're looking at these two types of investment is, I'll just give you a quick two lists here. All of these companies are from the from the S&P 500, all of them. So if you look at the list on the left, American Airlines, Ford, Gap, etc., and you look at the list on the right, Amazon, Clorox, who do all the cleaning fluids, Colgate, Johnson & Johnson, Netflix, etc. Now, if we're just about to go into lockdown, we've got COVID-19, we're all going to have to work from home. And I said, do you want to pick the companies on the left, or do you want to pick the companies on the right to invest in? I'm pretty sure that everyone would say, well, airlines aren't going to fly, no one's going to buy a car, Las Vegas certainly, and most certainly no one's going to go on a cruise anytime soon. So yeah, I think we'd all pick the one on the right. Now, again, like I said, these are all big companies. They're all in the S&P 500. Therefore, an ETF will hold all of these. You'll hold good companies, but you're guaranteed to hold the companies that you believe won't do well. Whereas a fund has the flexibility to choose between them. And then, of course, they don't all get it right. But again, the two that I mentioned earlier, Fundsmith and the UOB United Global Quality and Growth, all of these companies are in one of those two funds. Some of them are in both, in fact. So it's interesting. Again, today, what would you invest in? For me personally, I'd like to just bring up the next slide, which is about the recovery. Everyone talks about recoveries being a V shape or potentially a W shape. I've heard L shape recently. Nike swoosh, that's a new one. So a recovery like this. For me, I think whichever one of those it is, in companies, it will be a K recovery. I think we're already seeing it actually. So you get a K, the strong will get stronger and the weak will get weaker. We've seen that already. Actually, even though the markets keep going up, it's only really the top 5 to 10% of companies that are doing well. They're actually bringing the market up. Majority of companies are actually really struggling. So I think this is a theme that will continue. I don't think that's just for now. I think that's going to continue into the future as well. So actually, where to invest? This is, I guess, the key slide for most people. I put quality, work from home, and long-term themes here. Quality, I'll start with that because that's very much what Fundsmith does and very much what United Global Quality and Growth, as the name suggests. And these companies, anyone that's spoken to me before, anyone that's been on my website and read some of the stuff, please do take the time to do it if you haven't. Or anyone that follows me on Twitter, etc. You'll know I keep going on about quality, quality, quality. And this is why it's proving to do very, very well. You saw how Fundsmith and UOB outperform the market, but you have companies by definition to be quality that have low debt, they're profitable, have strong balance sheets, they have a moat or a competitive advantage in their business or industry. They use capital effectively, whether that's a return on equity, ROIC, a return on invested capital, or gross return on capital employed, all very similar metrics. Basically, are they well managed? And it's exactly the type of company that's done very well in this environment. Interestingly, these two areas, the work from home and long-term themes, a lot of these will include quality companies as well. Work from home, you need to consider what's the new norm. Things like Netflix have done very well. Amazon, is everyone going to be ordering from home? Logistics, online companies. Also connectivity and cloud as well. This is a big area that we're using Zoom right now. Many companies that haven't already will be looking at enterprise solutions. These are really, I don't think work from home is going to take off quite how some people think or rather want. I don't believe everyone's going to work from home full stop. But it is quite clear that we can do a lot more work than perhaps we thought from home in a more effective way. But also, what are the long-term themes? Because if everything's coming down, this is the time to, to really look to get in the things that are not just cheap, but are going to go up. You want to catch the top part of the K, not the bottom part of the K. So the long-term themes for me are very clear, 5 very clear standouts. Innovation. This can be in many sectors, but companies that are innovating, companies that are disrupting. Like I said, a lot of companies will get stronger and grow from this. A lot of companies will get weak and subside. Tech obviously covers a very broad theme across all of these parts. Healthcare, for me, has always been a bit of a long-term no-brainer. We're getting older as a population. There are more and more health problems. And then things like COVID-19. Suddenly there's a massive amount of people and companies trying to find treatment for COVID, trying to find vaccines. And this will continue, even past when we have these solutions. There'll be something else, and there'll be other areas, diabetes, heart disease, etc. These are big things that didn't exist hundreds of years ago. So healthcare for me is a big long-term theme. And 5G will still happen. It will still roll out around the world, and it will be huge. And it will be huge for chip makers, tech companies, etc. So I think these sort of 5 themes are ones to look for. Bear in mind, the work from home, is that going to change? Are we in a new norm? I don't think anyone really knows yet, but let's see. And then of course, quality. Can you get the companies that tick these boxes, but also are well managed, look after shareholder value, etc. This is really what you want. So just quickly go back to that, remind you that the ones that do tick those 3 boxes have done well. They're actually positive this year. But the next thing is then, are markets too high? I think this goes back to, should I invest now or should I wait? You do have some pretty bad data, or very bad data, I should say. According to Reuters, 30 million Americans have sought unemployment aid in this period. That's a huge number. The employment rate is now 14.7%. Actually, it's higher because this is at the end of April. And according to the UN ILO, they reckon 305 million full-time jobs have been lost or will be lost during this COVID-19 period. 305 million jobs lost. Just to, again, to put that into context, that's not far off the total population of America. It's roughly 4.5 to 5 times the population of the UK. It's a huge number. The other problem is recession. It is coming. I put Q2 guaranteed, only because Q2 is not over, but yes, it's pretty much guaranteed. I don't believe it will be a recession. I think it will be a recession. But we're all getting excited, and the market's getting excited about lockdown being unlocked. Is that actually going to lead to consumption, though? That's a big question. You've got to bear in mind the context of all these people have lost their jobs. Are those people going to go out and spend money again suddenly? It tells a tale that there's little forward guidance. The stock market is a forward-looking indicator. But companies right now, a huge majority, 90% plus, can't even give estimates. They can't give any forward guidance for earnings, for revenue, for sales. And that's pretty worrying. Australia's come up with a very bold statement that basically they think they're going to have the worst recession in history. That's huge. Forget financial crisis, forget the tech bubble, which didn't really affect Australia, but forget even world wars, Great Depression era. They believe this will be the worst recession in history. We've got government debt, we've got corporate debt, we've got individuals in debt. And I do really think we're going to see this insolvency, bankruptcy, and delinquency period. This is my biggest concern, and this, I believe, has probably only just started. I think we've got a lot more to come in this area. Again, if companies go bankrupt, are they going to re-employ all these people? That's what everyone's hoping, right? That they're going to get re-employed. But if companies are going bankrupt, they're not. AAPR does a lot of research for federal agencies in America, and they did a survey across all small businesses at the start of April, and 55% said they would not survive, they would not exist anymore if there was a lockdown for 3 months. Well, we've had 2 months since then, so anyway, I don't want to try and scare people. It's just trying to put this context in place. Anyway, should you wait to invest? No, I don't think I need to explain this slide anymore. It's quite self-evident. No, you should not wait. You should invest. And you might say, why? You know, all those things you just said, markets high, etc. But remember what investing is. It's not short-term money. Okay? It's the use of money that's not needed in the next year or so. Okay? It is time in the market, not timing the market. This is quite an old saying that I come across a lot, but it's very true. And actually crashes and recession are investors' best friend because you are in it for the long term. Legendary investor Peter Lynch, who became a billionaire actually from investing and was a star at Fidelity when they first came up. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has actually been lost in corrections themselves. I think that's quite a powerful statement. Just moving on quickly to put that into real numbers. This is a chart here, and I'll be sending these slides out and you'll get a recording, but you can take a screenshot. But basically, going all the way back to 1999 through to the end of 2019, you get a 6.1% per annum return if you stayed invested. However, if you didn't and you played the market and you missed the 10 best days, just the 10 best days out of over 5,000, that 6.1 goes all the way down to 2.4. Actually, if you miss 50 best days, okay, that's not even 2 months. It's roughly 2 months. Actually, that goes down to minus 5.5%. That's a huge difference. So that really helps you think about staying invested. Again, putting it into more recent context, the great financial crisis in this period. Imagine if you'd invested all the way back here, so through the 2001 recession, through the global financial crisis, right through to today, your $100 would be worth $311. But if you'd waited to the end of the recession after the global financial crisis, so you let the dust settle, you missed this big violent crash here, you missed this big violent crash there. Actually, it doesn't look that bad there, does it? But 203. It's only 2/3 of the return. It's quite a powerful historical lesson to stay invested. Okay, so conscious of time, I'd said I wanted to finish to give time for Q&A, which I still do. But very quickly, how much to invest and when? For me, there's only 3 tactics, and these will be different for each of you. Maybe all 3 apply, but the first, which is the easiest, is just regular savings plans or dollar cost averaging. Regular weekly, monthly, or quarterly amounts. You just take the timing out of it, the emotion, just do it on a regular basis. Often it's easier as well. Or a similar method is just invest in tranches. If you have money today, but perhaps I've scared you a bit with some of the bad data, or maybe I've excited you that there's lots of returns ahead. Invest, as an example, like I said, these percentages will be different for everyone. 40% today, 40% if there's another drop, and 20% if there's another drop. Or if there's good news that comes about. I mean, the third one is topping up. If you already have investments, you should certainly think about topping them up. You earn money every month. Well, most of us do, those of us still working. You have new money all the time coming through. Cash in the bank earns nothing. It won't earn anything for the next 5-10 years. And inflation's there. So you really need to get money working. And hopefully I've demonstrated reasons why to invest. Quick example on tranches. I'll rattle through this very quickly, but simply if you, in the context of this latest crash, again, this is the start of this year. If you invested towards the peak, that 40%, then you invested again when IPP said, or after a 30% drop, and you invested again, this the last tranche, as things are coming up earlier this month. Today, or 2 days ago, you would have actually made about 7.5% return. So even though you invested just before the peak and just before this big crash, you're still up 7.5%. You don't have time to do it yourself. Another core strategy that's available on some of the platforms is the CGWM Opportunity Fund. They have a fully flexible cash mandate, which means that they can do this tranche timing instead of you, if you don't have the time or the ability to do it. And what's interesting is today, they're currently at the 25% cash level. Yeah, so before that, they did that, you know, when we had a 2015 time, 2011, 30, you can see actually 2008, 2009 up to 45%. So it doesn't stay all the time, they utilize the cash accordingly. So this is an interesting one if you can't react fast enough or you get too emotional when investing. And then the last one I talked about was dollar cost averaging. You have 2 funds here. This actually has years because it's from an old document that I have, but you can replace that with months. Call that the next 10 months. This shows if you invested 4,000 every month, what would it be worth at the end of 10 months? Now, you would think you want to invest in something that's going up all the time. as opposed to something that goes down and then goes up again, which could be the market for the next 10 months. You can see the total investment value at the end is significantly higher by investing in the volatile market. Again, food for thought, because perhaps this is the next 10 months we're looking at. Okay, last thing, I'm going to finish up now. What else to invest in? Because I could talk all day about investing, as most of you know. I've talked mainly about equities and particular areas that I think are good. I think 3 areas to certainly consider, and probably everyone should have. The first two, more from a diversification perspective, is gold. I'll just leave you with the fact that I said inflation would come back. You know, there's definitely a lot of economic and political instability. But also, remember the amounts of money that's being printed. Paper money is going to lose value and continue to lose value. It's not a short-term trend of the last decade. It's a trend that's going to increase, increase, increase. Again, gold has a physical store of wealth. China as well is a very interesting one. China got far less hit even during this COVID crisis than the developed world, even though we all blame China for it, or certainly Trump does. And I'll come on to that in a second to finish up. And the last one is ESG, environmental, social, and corporate governance, sustainable investing. This is going to be a huge theme. It's already very, very obvious when you look at the markets that this is affecting companies. Sustainable companies that take ESG seriously are outperforming unsustainable ones. I think everything that's happened with COVID-19, this is going to put an even bigger focus and an even bigger emphasis on ESG in the future. So quickly, China, I just mentioned that. I think, if I'm not wrong, this is the last slide. Why I said China, a lot of people probably, I can't see you, but probably like, what, China? No way, man. No one trusts them. I don't trust them. I've all seen, you know, What the Hustle on Netflix. But the bottom line is, as a country, and I'm talking about domestic China here, I'm not talking about trade wars and global logistics, etc. As a domestic economy, they're in better shape than even the US, but absolutely certainly than Europe. It's very insulated from all of this. They're already getting back to work. We're getting excited about potentially opening up next week. Europe has only just started opening up, and not all countries have. They're already back to work. China is pretty much, I forget whether it's 88, 78 or 98%, but one of those 3, completely back to normal from a work perspective. I mentioned stimulus. They haven't really done those $1 trillion stimulus that the Eurozone and the US have. So they still have that in their armory. That could still be used if things turn bad. And consumption has picked up in China already. You can see in this COVID period, look, it's hardly lost versus the developed world. It's a really big difference. And again, just to sum up how insulated they are, last night, if anyone watched the US markets, we've had a really good week. Everything's gone up. They opened up, they went up quite a bit throughout the session last night, and then they fell, and that actually ended up lower. And the reason for that was concerns, again, about the US and China relations and trade wars. Interestingly, domestic China today, when I look at the MSCI, the CSI 300, the domestic Chinese index, it was up 0.3%. So you can see there's a really different disconnect. So it adds some diversification for sure. So hopefully I've given you some food for thought. If there's any questions, please put them in. I've had one question that asking about the recording. Yes, we will share the recording afterwards. You should automatically get sent it. If you don't, please just give me a shout. You can see my email address there. Or if you have an advisor at IPP already, just ask them and we can forward it. But you should be able to get the full recording, and anyone that wants the slides can have the slides, and that's fine. And if you want to speak to me, like I said, you can give me a call, give me an email. I'm happy to talk and catch up. We just had another question. So what about currencies? The US dollar has strengthened a lot. Will that continue? Yes, I think so, if I'm honest. If you remember the context of what I was saying, I believe that at some point very soon, we've got to have a correction. Actually, I think it all revolves around Q2 data, so basically the middle of July, we'll get GDP data from global economies for Q2. and we'll get corporate earnings reports from companies for Q2. They're going to be very bad. Q1 was bad, but don't forget that's masked by a very good January and February. Everyone's been in lockdown pretty much all of April and May. They're going to be horrendous, I think. I really do. So if we recall the worst weeks of the recent crash, and actually back in 2008, 2009 as well, the US dollar strengthened a lot. It's a safe haven currency, rightly or wrongly. So I do feel that if there's another correction, we'll see another bout of further US dollar strength. But also, even though there's all this printing, like I said, paper currencies are losing value. And that is going to be a long-term trend, which is why you should look at gold as a diversification tool. But it's probably, to put it in a good saying, it's the best house in a bad neighborhood. Europe are printing money as well. The European economy, the euro, the eurozone, I'd have a lot less short-term confidence that that's going to bounce back. So yeah, I think the US dollar is probably still a good currency for the short term. Longer term though, I think you should unravel. But ultimately, as with everything, look for diversification, and that goes for currencies as well. I had another question, what about REITs? Okay, I could talk a long time about that. It really depends on what type of REIT. REITs are real estate investment trusts. These are a great way, and traditionally a great way actually for people to invest in order to get income. Depending on the legal structure and the country they're listed in, they have to give a certain proportion of their income out as distributions to their investors. So it's a great way of getting income. The yields are typically very, very good. I would be cautious, again, depending on specifically what type of REIT. You get residential housing REITs, you get mainly commercial. So you have to look at which country, what sectors, if they are sector specific. Sometimes you can get logistics REITs or REITs focused on shopping centers, for example, or office REITs. Now, based on everything we've just talked about, I think offices aren't going to be expanding. Companies aren't going to be opening offices in new countries in a rush. And unfortunately, a lot of companies will go under, which of course will affect REITs. So I would be cautious at the moment. They're typically very volatile. If you're confident that they're in a very sort of, or a safer part of the market, then hold them because they're great income generators. But yeah, they're very volatile. And like I said, I do think they have a unique risk with all that's happening at the moment. Perhaps a logistics trust could be interesting, especially with all the online shopping. We've seen Alibaba explode, Amazon's just going from strength to strength. I'm pretty sure everyone like me and pretty much everyone I know is just ordering everything. Everything we want now is on the phone. I know obviously all we want to do is go out and get it, but I think online retail is a big, big sector. And actually just going on to that quickly, we've heard Debenhams have got a lot of issues in the UK. This will be a trend. Someone said it to me a few weeks ago, actually, and I can't recall who it was, but the number of of physical retail shops that are closed at the moment because of lockdowns, so many of them simply just won't open again. They won't exist. Everyone will be using online. So it's a really big shift, and we talk about this new norm, and like I said, no one really knows what the new norm is going to be like. But I can tell you there's going to be a lot more e-commerce opportunities and online shopping. So yeah, I'd be cautious with REITs, but maybe logistics REITs are a good thing to look at. Someone's just asked me about Brexit. Thanks for that. I think we need another 2-hour session. And like I said, I'm not going to talk politics. Brexit for me, just very quickly in sterling. I think obviously COVID-19 has been a very bad time from the UK perspective, and the Eurozone. It's been a very bad time in terms of Brexit because supposedly we're getting prepared to actually do it at the end of December this year. Now, whether that still happens or not and in what form, who knows? It's still going ahead. I mean, Brexit will still happen. hard, soft, no deal, whatever it may be. As anyone that's spoken to me before will know, my views are perhaps patriotic, maybe blindly naive, because again, it's an extraordinary event that really there's not that much fundamental sort of technical analysis that can be done around it. But I do feel that if you can give it 2, 3, 4 years, UK investing, whether that's the stock market, real estate, property, REITs maybe, and the currency, pound sterling. I really do feel if you've got a 3, 4, 5 year horizon, it's an excellent opportunity. I really do. Like I said, I'm very biased. I'm from the UK originally. I do have a number of pound sterling investments. I've got a property in the UK. I'm very biased. But yes, I do really feel that, you know, whether I voted for Brexit or not, that's irrelevant. It's happened. And yeah, I actually think the UK, pound sterling are both opportunities for sure. Okay, well, it's 6 minutes past 6. Are there any more questions? I'm happy to field another couple now. Otherwise, I'm sure people are keen to get off and eat dinner, have a glass of wine, have a beer. Oh, we've got one more. Okay, so final question. You mentioned that money in the bank does not grow, especially when interest rates are now lower. Apart from all the investments talked about today, where else can people keep money to be ready, stroke available if necessary, and minimize the effects of inflation? Okay, it's a good question. Again, it kind of depends on time frame. If you're talking about a few months, obviously it's irrelevant. If you're talking about sort of, you know, 6, 9 months, maybe 1, maybe 2 years, but certainly not the 5, 10, 15 year horizons I mentioned before, then it's a tough one. It is a tough one because absolutely inflation is definitely here. It was already here. And I believe inflation will increase, in fact, after all of this. It is a tough one. You can look to bonds. Bonds, again, can vary vastly because you have some of the riskier bonds like high yield. Again, if you have bankruptcies happening, you don't really want to be in high yield bonds because you will get defaults. So perhaps looking at the safer end of the spectrum, I'd say investment grade corporate is interesting. You can still get some decent yields without too much fluctuation. Government bonds, I mean, you don't get the yields, but at least you get the safety. But to be honest, government bonds, perhaps, maybe it's not worth the hassle unless you're talking a lot of money. I think corporate bonds would be the place to go. I think Asia is interesting, or Asia Pacific, I should say, which includes Australia. Now you need to be careful again on the default side, but if you go investment grade, you can still get some good yields. Corporate bonds are still yielding 4, 5, even 6%, some of them. So there's some good options there. You just need to scrutinize the companies very carefully, because like I said, there will be bankruptcies, or at least use managers that have, you know, a good track record and a lot of experience. And like I said, stick to the investment grade side of things. I think it's better safe than sorry. Hopefully we won't have another shock event like we did in the start of March. Everything fell, literally everything fell. Even gold fell. But also bonds did. Bonds got hit very violently for 4 or 5 days. And that was more a liquidity crunch. That was a loss of investor sentiment. I think if I can get back on here, do I have a slide on? Let's see. There's a lot of slides, sorry about that. Yeah, okay, so if we look here, I think it was this one. This whole sharp drop was accompanied basically by everything falling. So bonds lost value, gold lost value, actually everything apart from the US dollar. So it goes back to my question before, the US dollar could be a standout currency. But of course, a lot of the bonds have recovered with that. And what happened here was all this stimulus. So where's the one, what did governments do? Yeah, this one. All of this $1 trillion of market liquidity, this was the key. So that shored up markets, it gave people the peace of mind. So I don't think, I never like to say it won't happen because it'll probably happen tonight. But I can't see that same event occurring again in the bond market. So I think if you stick to investment grade, unless if you look at high yield that maybe avoids places like oil and gas and real estate, hard to find, but possible, or perhaps some emerging market debt as well, that will have a tough time whilst the US dollar continues to strengthen. But the yields are great. So actually, again, as a longer term investment, that would be good. But for short term, to answer the question, it's tough, but a diversified portfolio of corporate investment grade bonds, I think, is the way to do it. I think you can still achieve 3, 4, even possibly 4 to 5% on that. Okay, right. That's it for me. I don't know how many people are still listening. Am I just talking to myself? I need to check actually. How do I know there's still 20 participants. Good. Okay, right. Well, thank you very much, everyone. You have a lovely evening or day or night, depending on where you are in the world. And like I said, any questions at all, I'll just bring up my email again. Yeah, feel free to email me, give me a call, send me a WhatsApp. I'm happy to help. Or like I said, if you have a financial advisor or IPP already, just give them a shout and yeah, we can take it from there. And if you're not already an IPP client, please do definitely contact me and we can have a talk. Anyway, I hope you all found it useful. Take care.